Hi everyone, welcome to Dezerv's monthly market update. Today we have our co-founder Vaibhav Porwal with us. So Vaibhav, let's jump straight into the discussion of what is causing all this volatility in the market right now. From its all-time high, Japanese index is down by around 25%, followed by US Nasdaq, which went down by 12%. Yes, comparatively, Indian markets went down by only 4%. But what are the factors that has caused all these uncertainties in the market right now?
So it's not something new, Kriti. Some of these pockets of volatility have been bubbling up for quite some time. We have this whole Israel and Hamas situation which has been going on for last 6 months. We saw some escalation there when the chief of Hamas was assassinated in Iran. That created a renewed fear of escalation of war, and escalation not just between Israel and Hamas but expanding beyond Israel and Hamas, and contagion of that playing out in the whole Middle Eastern region. So that was one factor which made the markets really nervous. Second factor was the yen carry trade unwinding fear. Now the Japanese central bank has increased rates again. So they've taken it up to 0.25%. It's unnatural for Japan to see these kind of rates. Traditionally, the Japanese interest rates have hovered close to zero. And most of the traders have capitalized on that by borrowing money in Japanese yen and investing in assets of other countries and benefiting from the spread between the two currency and asset classes returns. So that trade unwinding fear was widespread whole of last week. Japanese yen appreciated by almost 14 to 15%, and which created this fear that there will be large unwinding of this trade. An estimate is there that the size of the trade is almost $20 trillion. So which is a large number and which will have significant impact on the global market. Now the third factor, which again was not a new factor, we heard about it in the past, the fear of US economy sliding into recession. The unemployment data which came out rekindled that fear, and because of that the US tech stocks started correcting. So all three factors played out together and created this bout of volatility. Thankfully for us, central banks are far more agile today. The Japanese central bank intervened immediately and gave a lot of comfort to the market by saying that they will do whatever it takes to stabilize the market. So that's why the volatility was short-lived.
So Vaibhav, amidst all this volatility, what are the things that secured the Indian markets and did not cause so much correction in our space?
No, three things. First, Indian markets are not exposed to yen carry trade. So therefore, there is very minimal direct impact of that on Indian markets. The exposure of yen in Indian market is limited. Second, the Indian market is supported by this gush of liquidity which is coming from domestic investors. Today we saw this number of 23,000 crore of SIP flow which came in the month of July. So this domestic liquidity is acting as a buffer, or it's giving a lot of cushion to Indian equity market. The third factor, and which to my mind is the most important factor, is resilience of Indian economy. When you look at the tax collection, we just saw the direct tax numbers, the number of returns filed have gone up meaningfully. We've seen the GST collection for the month of July. It came at a staggering 1.82 lakh crores. And we saw the way fiscal situation is improving for Indian economy. In the budget, the finance minister announced a fiscal deficit number of 4.9% for the current financial year, which is much lower than what everyone had expected. So all these factors are making Indian markets extremely resilient.
So Vaibhav, it's great to know that Indian markets are quite resilient to what is happening globally, and there are pockets of the market which will continue to perform well. But apart from all these factors that we just discussed, what are the other things that investors should watch out for in the coming months?
So there are some factors that we are looking at. Some of them are domestic and some are global. So on the domestic front, the most important factor for us right now is how monsoon will play out over next 45 days. The monsoon has been erratic so far. In fact, RBI in today's monetary policy meeting has resisted the temptation to reduce rates because of one single factor of risk of food inflation. If monsoon plays out well, then food inflation will start going down, and that will give a lot of comfort to RBI to start reducing interest rates. So monsoon and linkage of that with food inflation and linkage of that with interest rate is something that we are looking at very closely. Second domestic factor that we are looking at closely is how corporate earnings play out over next 6 to 9 months. The current quarter's earnings saw a marginal slowdown compared to the previous year. And given that Indian markets are still trading at premium valuation, it's important that earning momentum continues. So that's the second factor. Third factor that we are looking at closely is how global central banks react on interest rate front. Globally, we've seen US also giving some indication that they will start reducing rates from September onwards. If that were to play out, that will again reassure the Indian central banks also to go ahead and start reducing rates. So these are some of the factors that we are looking at very closely.
Vaibhav, the last thing that I want to ask you after all the discussion around the global and the Indian economy is what is your take on the various asset classes, especially after the recent tax changes in the budget?
Sure, let's look at all the asset classes one by one. Equity, as I said, valuations in India are premium, therefore earning momentum is important. We are recommending all our investors to stagger their investments over time instead of doing lump sum investment right now. As we discussed even in our last monthly market update, that it may not appear really glamorous to do SIP, but maybe SIP is the right approach to take in the current market. And within equity market, lean towards large cap side of the market. On fixed income, we believe that time has come when interest rates will start going down. So maybe it's a great time to start looking at longer duration papers. So investors should look at some longer duration papers in their portfolio. Gold has become attractive again through mutual fund route. ETFs will start getting taxed at 12.5% after the recent changes which were made in the budget. So gold is something that we are comfortable holding up to 5% of the client's portfolio. And the last thing, real estate. I think real estate money will start flowing into financial assets again. Real estate doesn't look as attractive as other asset classes, and I believe that Indian investors will continue to move away from real estate and look at other asset classes like equity and fixed income.
Great, Vaibhav. Thank you so much for such an informative video. I'm sure it will help our investors take some better decisions with their money and ride what is the upcoming volatility smartly.
Thanks.
And thank you so much, and watch out for our next monthly market update.